Hello, and welcome back to Boni's Life, the channel where we cut through the noise and give you the signal. I'm your host, Boni, and today we're diving deep into the crypto market's psyche. Is it just being moody, or is there a method to this madness? We'll be dissecting the market from every angle imaginable. For our day traders, our swing traders, and our long-term visionaries, we're going to look at the hard data, the global headlines, and the squiggly lines on the charts to figure out not just where we are, but where we might be heading next. And trust me, you'll want to stick around for our strategy session at the end, where we'll turn all this analysis into actionable trade ideas. So grab your coffee, silence your notifications, and let's get into it. Let's start with the 30,000-foot view. As of today, November 13th, 2025, the global crypto market capitalization is hovering around a colossal $3.6 trillion. Now that's a number so big, it almost sounds fake, like the number of times I've promised myself I'll start going to the gym. But what's interesting is the nuance. We've seen a slight 0.1% increase in the last 24 hours, which in the crypto world is the equivalent of a flatline. It's the market holding its breath. The 24-hour trading volume is a healthy $184 billion, so there's definitely activity, but it's more of a nervous shuffle than a confident stride. Bitcoin's dominance is sitting at a hefty 57.5%, with Ethereum trailing at 11.9%. This tells us that in times of uncertainty, the market still clings to the king, Bitcoin, like a safety blanket. It's the OG for a reason. When we look at the top performers, Bitcoin is trading at $103,699, up a modest 0.4% in the last 24 hours. Ethereum is showing more strength at $3,544, up 2% in the same period. This divergence is worth noting. When Ethereum starts outperforming Bitcoin, it often signals that risk appetite is returning to the market. Traders are willing to venture beyond the safety of Bitcoin into assets with higher beta. Now, you can't trade in a vacuum. The world outside our charts has a funny way of crashing the party, and lately, the party crashers have been out in full force. The biggest news is the draft of a new crypto market structure bill from the US Senate. This is the kind of stuff that makes institutions either write a very large check or run for the hills. The bill proposes classifying Bitcoin and Ether as digital commodities under the CFTC's watch. This is huge. It's like giving crypto a hall pass to the grown-ups table. It provides a level of legal clarity that big money players have been begging for. The bill also wants to force crypto companies to separate their various businesses. So no more one-stop shops for everything from exchange to custody. This is a direct response to the meltdowns we've seen in the past, and it's a sign of the market maturing. The impact? A potential flood of institutional capital into regulated tokens, while the Wild West of unregulated altcoins might get a little lonelier. This bill won't be passed tomorrow, but it's a massive signpost for where the industry is headed. What's particularly interesting is the bipartisan support this bill is receiving. When you have both Democrats and Republicans agreeing on something in Washington, you know it's serious. The Senate Agriculture Committee, led by Chairman Boozman and Senator Booker, has laid out a framework that could fundamentally reshape how digital assets are regulated in the United States. This isn't just about Bitcoin and Ethereum. This is about creating a regulatory environment that could attract trillions of dollars in institutional capital that's currently sitting on the sidelines. But it's not all sunshine and regulation. We're still feeling the aftershocks of the Trump tariff tremor from last month. A surprise announcement sent a $340 billion shockwave through Bitcoin's market cap, triggering record liquidations. It was a brutal reminder that crypto, for all its talk of being a separate system, is still highly sensitive to geopolitical and macroeconomic events. It's like that one relative who can ruin a family dinner with a single comment. The market has since clawed its way back to the $103,000 range for Bitcoin, but the memory lingers, and traders are understandably a bit jumpy. This event highlighted something crucial. Crypto is no longer operating in isolation. It's becoming increasingly correlated with traditional markets, especially during times of macro uncertainty. When the US dollar index moves, when gold fluctuates, when geopolitical tensions rise, crypto reacts. This is both a blessing and a curse. On one hand, it means crypto is being taken seriously. as an asset class. On the other hand, it means we can't ignore what's happening in the broader financial world. So, how is the market feeling about all this? To answer that, we turn to our favorite emotional barometer, the Crypto Fear and Greed Index. Right now, it's flashing a score of 14. That's not just fear, my friends, that's extreme fear. This means investors are acting like they've just seen a ghost in the machine. But here's the thing about extreme fear. It can be a contrarian indicator. When everyone is panicking, it can sometimes be the best time to be greedy, as the old saying goes. It suggests the market might be oversold. This sentiment is echoed in the long-short ratio, which is currently at 47.95% longs to 52.05% shorts. It's a slight bearish tilt, but not a landslide. It's a market divided, with a slight edge to the bears. Historically, when the fear and greed index drops below 20, we've seen some of the best buying opportunities in crypto. Think back to the COVID crash in March 2020 or the China mining ban in 2021. Both times, extreme fear preceded significant rallies. Now, I'm not saying we're guaranteed a rally here, but the setup is interesting. The market is scared, positions are being liquidated, and smart money often accumulates when retail is panicking. Let's get into the nitty-gritty of the derivatives market. The total open interest in crypto futures is a staggering $141.6 billion. That's the total value of all outstanding contracts. It's down about 1.3% in the last 24 hours, which aligns with the market's cautious tone. But here's a fascinating detail. While futures are cooling off, options are heating up. Open interest in options has jumped 8.7% to $68 billion. This suggests a shift towards more sophisticated trading strategies. Traders aren't just betting on direction anymore. They're using options to hedge, speculate on volatility, and structure more complex positions. This is another sign of institutional players getting more comfortable in the crypto sandbox. When we break down the open interest by asset, Bitcoin dominates with $67.18 billion, followed by Ethereum at $39.02 billion. Solana comes in third with $7.53 billion. What's interesting is that Bitcoin's open interest is actually up 0.47% despite the market pullback, while Ethereum's is down slightly at minus 0.12%. This tells us that traders are still willing to take leverage positions on Bitcoin even in this uncertain environment. The options market growth is particularly noteworthy. Options give traders the ability to profit from volatility without taking on the same level of directional risk as futures. The fact that options open interest is growing faster than futures suggests that traders are expecting big moves, but they are not sure which direction. Now, for the part of the show that's not for the faint of heart, liquidations. In the last 24 hours, we've seen a whopping $565 million in positions wiped out. That's a 32% spike, and it tells us that a lot of traders got caught on the wrong side of a volatile move. The majority of these were long positions, which suggests a wave of over-optimism got brutally corrected. Ethereum and Bitcoin took the biggest hits, with $20 million and $14.5 million in liquidations, respectively. This kind of event is a painful but necessary market function. It washes out the excess leverage and often marks a local top or bottom. It's the market's way of saying don't get too comfortable. When we see liquidation spikes like this, it often creates opportunities. Why? Because forced selling creates inefficiencies in the market. Traders who are liquidated aren't selling because they think their asset is overvalued. They're selling because they have to. This can create temporary price dislocations that savvy traders can exploit. The fact that long positions dominated the liquidations tells us that there was too much bullish leverage in the system. That leverage has now been flushed out, which could actually be healthy for the market going forward. All right, let's put on our technical analyst hats and look at the charts, starting with our long-term investors. If you're a hodler, you're looking at the weekly and monthly timeframes. The big picture for Bitcoin is a battle around the psychological $100,000 level. We've seen it act as both support and resistance over the past few months. The 200-week moving average, a classic long-term indicator, is currently sitting around the $75,000 mark. This is your ultimate line in the sand. As long as we're above it, the long-term bull market is technically intact. A break below that would be a major cause for concern. For now, the key support level to watch is $100,600, with major resistance at $108,500. For the long-term investor, the strategy is patience. Accumulating on dips towards the lower end of this range could be a viable strategy, with a clear invalidation if we lose that critical 200-week moving average. The monthly chart shows that Bitcoin has been in a macro uptrend since the 2022 lows. We've had corrections along the way, but the overall trajectory has been higher. The current consolidation around $100,000 is actually quite healthy. After a parabolic move, markets need time to digest gains and build a base for the next leg up. The volume profile shows significant accumulation in the $95,000 to $105,000 range, which suggests this area could act as strong support going forward. Now for our swing traders who live and die by the daily and 4-hour charts. This is where things get really interesting. Bitcoin appears to be building a base between $100,000 and $108,000. The daily RSI, Relative Strength Index, is hovering around 46, which is neutral territory. It's not overbought, it's not oversold. It's waiting for a signal. The MACD, Moving Average Convergence Divergence, on the daily chart is showing a potential bullish crossover, but it's not yet confirmed. This is a classic case of the market coiling up for its next big move. A swing trader's strategy here is to watch for a breakout. A convincing daily close above $108,500 could signal a move towards the next major resistance at $115,000. Conversely, a break below $100,000 could see us retest the lows around $98,000. The key is to wait for confirmation and not jump the gun. Let the market show you its hand. On the 4-hour chart, we can see a series of higher lows forming, which is a bullish sign. However, we're also seeing lower highs, which creates a triangle pattern. Triangles are continuation patterns about 70% of the time, meaning they usually break in the direction of the prior trend. Since we came into this consolidation from an uptrend, the odds favor an upside breakout. But again, we need confirmation. Volume is key here. A breakout on low volume is likely to fail, while a breakout on high volume has a much better chance of following through. And finally, for our adrenaline junkies, the day traders, you're living in the fast lane of the 1-hour and 15-minute charts. For you, the game is all about intraday levels and volume. Right now, the key intraday support for Bitcoin is at $102,000. We saw a sharp sell-off test this level, but it held firm. The primary resistance is at $103,500. A break above this could lead to a quick pop towards $105,000. A day trader's setup could be to long a breakout above $103,500 with a tight stop loss just below, or to short a breakdown below $102,000. Volume is your best friend here. Any significant move should be accompanied by a spike in volume to be considered valid. Without volume, it's just noise. For day traders, it's also crucial to pay attention to funding rates. Right now, funding rates on perpetual futures are slightly positive, which means longs are paying shorts. This is actually a healthy sign because it means there isn't excessive bullish leverage in the system. When funding rates get too high, it's often a sign that the market is overheated and due for a correction. The current funding rate of around 0.01% is quite neutral, which gives day traders more flexibility to take positions in either direction without worrying about getting squeezed by funding payments. So, how do we trade this market? Let's break it down by trader type. For the long-term investor, the name of the game is strategic accumulation. Consider dollar cost averaging into positions, especially on dips towards the $100,000 support level for Bitcoin. Keep an eye on those Bitcoin ETF flows. Consistent inflows are a strong sign of institutional conviction. Your risk management is your thesis. If the fundamental reasons you invested in crypto change, or if we see a catastrophic break of long-term technical levels, like the 200-week moving average, it's time to re-evaluate. The beauty of being a long-term investor is that you don't need to time the market perfectly. You just need to be right about the long-term direction And with the regulatory clarity we're seeing, with institutional adoption increasing, with Bitcoin ETFs now holding over 638,000 BTC, the long-term thesis remains intact. The key is to have a plan and stick to it. Don't let short-term volatility shake you out of good positions. For the mid-term swing trader, it's all about range trading until a clear trend emerges. Buy support, sell resistance. The current range for Bitcoin is roughly $100,000 to $108,000. Use indicators like the RSI and MACD on the daily chart to time your entries and exits. A bullish divergence on the RSI, for example, could be a good entry signal near the bottom of the range. Always use a stop loss. A good rule of thumb is to place it just outside the range you're trading. So if you're buying at $100,500, your stop might be at $99,500. If you're selling at $107,500, your stop might be at $108,500. The key to successful swing trading is discipline. You need to take your profits when the market gives them to you, and you need to cut your losses quickly when you're wrong. The worst thing a swing trader can do is turn a swing trade into a long-term hold because they're unwilling to take a loss. Set your levels, execute your plan, and don't let emotions drive your decisions. For the short-term day trader, it's about scalping small profits from intraday volatility. Focus on key levels and volume. Use a combination of horizontal support and resistance and moving averages on lower time frames. Be nimble. Don't get married to a position. If a trade isn't working, cut it loose. The high liquidation numbers we're seeing are a testament to the dangers of over-leveraging in a choppy market. Trade with a clear plan and stick to it. Day trading is the most challenging form of trading because it requires constant attention and quick decision-making. You need to be able to read the tape, understand order flow, and react to news in real time. It's not for everyone, but for those who have the skill and discipline, it can be very rewarding. The key is to keep your position sizes small relative to your account, use tight stop losses, and focus on high probability setups. Don't try to trade every move. Wait for the market to come to you. So, where do we go from here? Let's outline a few scenarios. In a bullish scenario, we see the new crypto regulation bill in the US make positive progress, boosting institutional confidence. Bitcoin breaks decisively above $108,500, leading to a squeeze of the short positions we've seen building up. This could propel us towards the $120,000 marks. In this scenario, we'd likely see Ethereum and other major altcoins outperform Bitcoin as risk appetite returns to the market. The fear and greed index would flip from extreme fear to greed, and we'd see a surge in trading volume and open interest. Bitcoin ETF inflows would accelerate, and we might even see new all-time highs before the end of the year. The catalyst for this scenario could be a combination of positive regulatory news, strong ETF inflows, or a macro event like the Federal Reserve signaling rate cuts. In a bearish scenario, the regulatory news turns sour, or another global macro event spooks the market. Bitcoin loses the $100,000 support level, and we see a cascade of liquidations, potentially pushing us down to test that crucial $75,000 level. In this scenario, the fear and greed index would remain in extreme fear territory, and we'd see significant outflows from Bitcoin ETFs. Altcoins would get hammered, with many losing 30 to 50% of their value. The derivatives market would see a massive deleveraging, with open interest dropping significantly. The catalyst for this scenario could be a hawkish Federal Reserve, escalating geopolitical tensions, or a major exchange or protocol failure that shakes confidence in the crypto ecosystem. The most likely scenario in the short term is a sideways grind. The market continues to chop around in the current range, frustrating both bulls and bears as it digests the recent news and waits for a new catalyst. This is actually the most common outcome in markets. After big moves, we often see extended periods of consolidation. In this scenario, Bitcoin would continue to trade between $100,000 and $108,000 for several weeks or even months. The fear and greed index would oscillate between fear and neutral. Trading volume would remain moderate, and we'd see alternating days of ETF inflows and outflows. This scenario is actually ideal for swing traders who can profit from the range, but it's frustrating for trend followers and long-term investors who are waiting for the next big move. The key in this scenario is patience. Don't force trades. Wait for the market to give you a clear signal before committing significant capital. And that's a wrap for today's deep dive. We've covered a lot of ground, from Washington politics to the nitty-gritty of liquidation data. The key takeaway is this: the crypto market is at a crossroads. It's maturing, with institutional players and regulators taking a more active role. But it's also still a wild and volatile beast, susceptible to global events and sudden shifts in sentiment. Whether you're a long-term believer, a nimble swing trader, or a fast-moving day trader, there are opportunities to be had, but also risks to be managed. The key, as always, is to stay informed, have a plan, and trade smart. Remember, the market doesn't care about your opinions or your feelings. It only cares about supply and demand, fear and greed. Your job as a trader or investor is to read those signals and position yourself accordingly. What are your thoughts on the market? Are you bullish, bearish, or just enjoying the show? Let me know in the comments below. And if you found this analysis helpful, do me a favor and hit that like button. Subscribe to Boni's Life and ring that notification bell so you never miss an update. Until next time, trade safe and may the profits be with you.